This is Bloomberg Intelligence.
We're really getting into now the streaming's arms race.
Dish is looking at that and saying we can really build a nice niche for ourselves.
In-depth research and data on 2,000 companies and 130 industries.
The dollar is the dominant concept in the planet.
I think the acquisition is a natural progression of what Microsoft can do with this technology going forward.
Bloomberg Intelligence with Alix Steele and Paul Sweeney on Bloomberg Radio.
On today's Bloomberg Intelligence show, we are going to dig inside the big business stories impacting Wall Street and the global markets.
Each and every week, we provide in-depth research and data on some of the 2,000 companies and 130 industries our analysts cover worldwide.
Today, we're going to take a look at the future of grocery e-commerce.
Plus, social media company X draws in scrutiny under the Digital Services Act.
But first, private capital fundraising is on track to finish this year nearly 20% below 2022, exceeding forecasts for a single-digit drop. For more, we're joined now by Bloomberg Intelligence senior banks analyst Paul Gulberg. Hang on a second. I thought private capital, private credit, like this was all the jam, and now fundraising isn't holding up?
Fundraising is a bit challenged, but as you absolutely correctly noted, the private credit is doing really well. There is fundraising in distressed funds, there is fundraising in direct lending. The private equity component is the one that's lagging behind, and it's kind of a cyclical issue.
Well, okay, so what is driving kind of this decline here?
Well, if you think of drawdown funds and the way LPs operate, so these funds typically get returned when the assets are monetized, and we've seen very little M&A activity still, which dragged on for quite a bit longer than a lot of people anticipated. So with that in mind, there's not much money going back to the LPs, and that's why they kind of slower in terms of reinvestment.
Yeah, I was going to say, so what is the problem then with the private equity? Is it just that exiting businesses is just hard? Like, is that the climate which we're in right now?
Yeah, it is, absolutely. It's a cyclical issue where it's more challenging, and we have to look at the M&A activity, what's going on. And, going into earlier this year, there was a lot of expectation that things were going to start opening up, and 10 months into the year, it's still kind of on the sluggish side. We can see it from the bank's reports.
Private credit, it's been just a phenomenal business for the last 15 years. I'm concerned about the risk there. It doesn't seem to be regulated at all. And if we go into a recession, there could be some real blow-ups in private credit. Is that a risk you hear out in the marketplace?
I do hear a lot of that risk, and I think you very correctly identified that the biggest issue is the transparency, not necessarily the credit quality of lending. So typically the covenants on the deals that private credit does and are better than the banks in many cases. Private credit often knows the companies very well, so the lending is quite good. But the problem is there is not much transparency like we get on the bank side, where you can get a much better kind of understanding of what's in there. But given where the levels are of delinquencies, there's still quite a bit of room for things to get worse, and the high rates are not helping.
I want to talk about mark-to-market. Private equity, it just doesn't seem like they mark-to-market frequently enough, well enough. I just never see any big markdowns.
Is that the whole point of private equity? You don't have to do that?
Well, they do. So they don't necessarily mark to market. They mark to cash flows, right, of these longer-term forecasts. So things don't move as much, although it's not necessarily true. If we go back to the first quarter of 2020, to the pandemic, there have been quite steep haircuts to the private equity valuations as everybody was concerned about the market, how it's going to turn out. But if you're holding things for 5 to 10 years, and if you're in the businesses that you're not really challenged in terms of a longer-term forecast, and you mark into cash flow, so that's why you kind of see the smaller marks. But, these marks typically do lag the public market. So there are areas where we can see steeper marks if markets don't turn around.
I understand the logistics of that is true, but I'm trying to understand who's left with their pants down when things get really bad in private equity, because no one in private equity seems to think it's going to be private equity.
Well, that's absolutely true. They invest LPs' money, right? Endowments, pension plans, and so forth. And there is quite a bit of expectation that the IRRs, the rates of return, are going to be a little bit softer for the vintages that has recently been invested. But if you're investing continuously with the same manager or similar managers, the new vintages are probably going to have better IRRs because you'll be able to enter at lower prices. So if you're in several consecutive funds, you're probably going to come out okay. Plus, the funds are typically diversified, so it's not that they hold in a dozen of investments and if one or two of them are going to blow up, they're really going to be in trouble.
So they all keep their pants. All right, fine. Paul, thanks a lot. Paul Gulberg, Bloomberg Intelligence Senior Banks Analyst. Thank you.
All right, let's turn now to big banks like JPMorgan Chase and Wells Fargo, who could soon see bail-in debt surpluses turn negative as the Fed implements new rules. For more, we're joined by Bloomberg Intelligence Senior Credit Analyst Arnold Kakuda. Arnold, this sounds like bank accounting. I don't like bank accounting. Tell me what's going on with some of these big banks and their balance sheets.
Well, basically, new regulation coming into play, primarily Basel Endgame, maybe.
What is Basel Endgame in for 30 seconds?
Basically, it's a global rule to normalize the risk weights that banks need to hold. Basically, banks hold assets. They assign a risk weight to say how risky it is. It's different globally. So they're trying to standardize that across the globe, and basically banks will need to hold more equity against those assets.
So when we say bail-in debt surpluses turning into a deficit, that just means like they have a lot of extra stuff, and now with the new rules, they don't have enough stuff?
Yes, if they were implemented immediately. But likely, there a lot of people are complaining about it, so things might get rolled back a bit. And then the implementation will probably be in like 5 years, right? So they have time, but...
So Jamie Dimon has 5 years to keep complaining about it.
Yes,
cool.
But what he's trying to say is, hey, you don't want to leave that uncertainty there, right? And people can keep on pointing to it quarter after quarter after quarter, which is kind of like what's going on with the regional banks right now with their adjusted equity levels. So JPMorgan has said, hey, we want to tackle this stuff immediately. So that's why they're increasing their equity levels to combat it on the equity side. And then part of that was our view is that over the midterm, we think they might need to be more active, but I think maybe you're seeing that.
Don't we always see the banks, a lot of companies, but certainly the banks, after they report numbers, they come to the debt markets. Explain to us why they do that.
Well, banks are, yes, frequent issuers, and then more and more with regulation, debt is becoming a requirement. For non-banks, it's an option. Right, they can finance themselves with equity or debt, but for banks, more and more debt is becoming a requirement. And in terms of the tenor that they issue, they typically issue in shorter tenors. So there's always this, if you issue in shorter tenors, you have maturities coming due. So to kind of have the same amount of debt on a constant basis, things mature. So you need to kind of replenish and reissue.
It's good to be a financial institutions group or FIG banker, isn't it? Because your clients are always issuing capital.
It's I guess it's what do you call it? Intercompany. So you
right.
can't really earn fees on that.
I'm charging fees, baby, if I'm doing a bond deal.
But you're an expert in that field. So when you have smaller players come and be like, oh, look at our league tables, or we do this much volume. Yep. If you count your own volume, that helps.
Right. So do the banks really need this?
Yes. So I mean, the U.S. is actually kind of slow. This regulation is coming out at an unfortunate time because, you think these things are getting implemented post regional bank stress, right? And so the perception is these things are being implemented post stress. Let's make the system better.
Yeah.
But it's actually a long time coming. I think this kind of framework has been around for like 10 years. And
so this is actually a post GFC thing.
Yes. So
Okay,
they're finally like 10 years later, they've come up with something, and then the U.S. has just been so slow, kind of putting in their final touches for this. So, even though the biggest banks came out really resilient, really strong through this crisis, lo and behold, the capital requirements, the equity requirements, and the debt requirements for the biggest banks are rising, whereas the regionals, it's rising too, but not as much. So it's kind of ironic. Right,
I can understand why putting equity on a bank's balance sheet is good. Why is putting debt on?
It's the cleanup, right? So these things are so systemically important. You can't, if something were to happen to JPMorgan, you can't just shut it down on a Friday, leave everybody with their payments and this or that hanging and then come out with a buyer on Monday. It's basically acknowledging that these things are so intertwined with the system that if one were to go down, it would bring a lot of the system down or chaos would happen. So, and kind of acknowledging that, these things, you cannot let these things fail. So having a lot of debt on the balance sheet already, you're able to convert the regulator can convert that debt to equity and kind of resume Frankenstein and let it keep on living.
But you know who also did that? Like the Europeans, and look what happened to Credit Suisse. Like, I appreciate it might have worked with Deutsche Bank, but like we've kind of seen something in practice work out. And I appreciate the issues with Credit Suisse wouldn't be the same issues with JPMorgan, for example.
Well, so the thing is, even the thing that, the what is it, 15 or 17 billion write down, that was on these CoCo securities. That wasn't on the senior debt. That were kind of this bail-in that
these were on the convertibles.
So these they had certain contingencies that are written in, but then they went with another clause saying if the regulator provided some assistance, these could get written off, right? But those are just a small slice. Those are the hybrids that sit between equity and the senior debt. For the biggest U.S. banks, it's more about they at least for JPM and Wells Fargo, they're going to need to increase their senior debt, right, which sits at the top, but still in a time of crisis, those can be bailed in.
Really interesting. Really cool stuff. Arnold, thanks a lot. Arnold Kakuda is Bloomberg Intelligence Senior Credit Analyst.
Coming up on the program, we'll reassess BI Treasury yield forecasts.
You are listening to Bloomberg Intelligence on Bloomberg Radio, providing in-depth research and data on 2,000 companies and 130 industries. You can access Bloomberg Intelligence through BI Go on the terminal. I'm Alix Steele.
And I'm Paul Sweeney, and this is Bloomberg.
You're listening to the Bloomberg Intelligence Podcast. Catch us Saturdays at noon Eastern on Bloomberg.com, the iHeartRadio app, and the Bloomberg Business app. Or listen on demand wherever you get your podcasts.
All right, let's talk about interest rates here. We've got some, we had some retail sales numbers that were strong this week. It seems like the consumer's doing fine. It seems like the economy's doing pretty well. The question is it higher for longer in terms of interest rates? For more, we're joined by Bloomberg Intelligence Chief U.S. Interest Rate Strategist Ira Jersey. Ira, what are you seeing out there in the marketplace? How do you think the Federal Reserve is thinking about the interest rate environment and maybe how it's impacting the economy?
Yeah, so I think that the Federal Reserve is going to start being a little bit concerned that the interest rate hikes that they've done so far haven't slowed the economy enough for them to even be thinking about cutting interest rates. And I suspect that Chair Powell and some other members of the Federal Reserve are definitely going to be looking at not only whether or not they should hike interest rates again, but also, like you mentioned, should they hold interest rates at the peak for even longer than what the market's currently priced for. And I think that it's very possible that by the December meeting, once we get there, they could even see the dot plot price out any cuts for 2024. And in fact, that would not surprise me at all.
Okay, so it seems like then the 10-year at 5% is like a done deal at this point.
Yeah, that wouldn't surprise me at all. In fact, we put out a note this past week talking about what ranges we might wind up being in. Usually, when you have very big moves like we had from mid-August to the current period, you wind up seeing these big moves in 10-year and 30-year Treasury yields, and then you wind up falling into a range for 2, 3, 4 months until the market kind of digests the incoming data. It prices kind of for a risk case scenario, and then the market kind of readjusts based on new incoming data, but you need several months of that data to come in before the market winds up adjusting. Now, so based on all of the preponderance of data that we've received so far, whether it was non-farm payrolls or this past week's retail sales or the non-farm payroll report, all of that suggesting that we're not yet slowing enough for the Federal Reserve to even turn dovish. So an on hold, I think, is what the market's most likely going to see. And like you said, I do think that we're going to see a pancake of a curve. So we can wind up seeing basically 5% across the board throughout the Treasury curve, and the market just to be pricing for, yes, the Fed to cut at some point in the future, but not anytime soon.
So the pancake, kind of 5% across the curve. Does that happen often?
That was my question. When was the last time we saw that?
Yeah, when's the last time that happened?
Yeah, it doesn't happen very frequently. Last time it happened was in the 1990s, but that's because the Fed was on hold for basically 3 years. You need to have a situation where the market starts to believe that the interest rate environment is going to remain steady for a long period of time. Now, I do think the front end of the curve will remain in somewhat inverted because at some point the Federal Reserve is likely to cut interest rates. It's a matter of when and by how much. Mm-hmm. And so if you think about just how interest rates have developed just over the last couple of weeks. If you go back to July of this year, the market was pricing for the Fed to cut interest rates in 3 or 4 years down to around 2.5%. Now it's pricing for the Fed only to cut to 4%, right? So that 150 basis point move is massive, and that's the big reason why you've seen this sell-off in the long end of the yield curve, because the market is no longer pricing for interest rates to be as massively cut compared to today's level. So if you think about what a 10-year yield is, that's going to be the average, more or less, of the Fed funds rate for the next 10 years. And we were priced before for rates to go to 2.5%. Now we're not. So that means that you're going to have structurally higher 10-year yields, at least until the market prices for a lower terminal floor.
But what is the effect of of a pancake, like on the economy? Just higher for longer everywhere, I guess.
Yeah, it should tighten financial conditions. I think that's something that you have started to see. If you look at the Bloomberg Financial Conditions Index, that has certainly gotten into tightening territory, or much tighter than it was. So I think that is one of the potential effects of that. And that's one of the reasons why you've heard some of the Fed speakers talk about that the Treasury market sell-off is doing some of its job for them. So you heard, for example, Lori Logan of the Dallas Fed. She's one of the people who said that because you had the sell-off in the long end of the yield curve, that maybe they don't have to hike interest rates anymore or as much, because the market's kind of doing their job for them. But this is what we talked about, and Alix, you and I have talked about this both on TV and radio before, which is that if the Fed could get all of these cuts priced out for end of 2024 and into 2025, that's as good as a hike. And that's exactly what's happened basically over the last 6 weeks since the August Fed meeting, is we've been pricing out more and more cuts. And as that's occurred, you should have the yield curve uninvert a bit, and even more than we already have, and that is currently our expectation.
And that's kind of where I was going to go. Everything I know about the inverted yield curve I learned from Lisa Abramowitz, but we're less inverted now. Does that mean there's less of a chance of a recession, or that if we do get one, it'll be more mild? What's that telling me? So
historically speaking, is when the curve starts to uninvert actually while you're in a recession, or even before you get into one. So kind of a recession is kind of a lagged outcome of what the market was expecting. So a lot of people say that, the yield curve's inverted, that means that we're going to have a recession. That's not actually what an inverted yield curve means. An inverted yield curve just means that the market's expecting interest rates to be lower in the future than they are today. That's all that it means. Now, the reason why interest rates are going to be lower is probably because of a recession or a broad economic slowdown, even if it's not actually a recession. So the idea that you have to have a recession because a curve is inverted is not necessarily true. In fact, you had a situation in the early 1990s when you didn't actually get a recession. So I don't think that will necessarily repeat this time, but then the curve starting to uninvert, I think, is more of emblematic of the idea that the Fed is not going to be cutting interest rates to the degree that the market had been pricing.
So if we go back to the cut part, and then say we do, so what seems to have happened is the more the market prices out the cuts, that the Fed officials come out and say, hey, bond market, you're doing my job for me. That's super cool. And then you get a rally in bonds. And then it kind of like negates that. How does the Fed, I'm assuming, would like some cuts to be priced out if they want to keep financial conditions tight. So how did they do that and still signal it at the same time?
So I think they have to jawbone it. I think that it would behoove members of the Fed and Chair Powell in particular at the November meeting and December meeting basically be a little bit more explicit in saying, look, here's the situation in which we're going to cut, without making any promises, right? Because they can always switch if the economic environment changes enough that they feel like they have to cut or hike interest rates in the future. But saying something like, look, we're definitely not cutting if inflation remains above 3% and the unemployment rate is below some kind of historical average. So if they say something like that, then I think that the market would say, okay, well, if that's the case, then their reaction function is they're not going to cut unless we see a significant deflation. And with retail sales like it was, and with some of the data that we've been getting, it doesn't seem like that's imminent. So the market will price out even more interest rate cuts. What I talk about, and one of the questions I get asked all the time is there still a Fed put, right? If the stock market goes down 20%, will the Fed cut interest rates? I think the answer is there still is a Fed put. We're just very far out of the money. That put is very far away. 20% down on equities probably doesn't do it if inflation remains high, right? So it's not only does it have to do with what's going on in the financial markets, it also has to do with what's going on in the real economy, and so that put exists, but we're just way far away from the strike of that put.
All right, we've done a lot of jawboning here, but I think the takeaway is Ira's telling me I'm not going to be able to refinance my recently purchased mortgage anytime soon. Is that kind of the takeaway, Ira?
Yeah, that's probably pretty fair. I don't. Mortgage rates might go down a little bit because of spread tightening in the mortgage market if liquidity gets better, but it's not going to be because 10-year yields are going down to 2% anytime soon.
All right.
Sorry, buddy.
Yep. All right. Yeah. Thank you very little. All right. Thanks to Bloomberg Intelligence Chief U.S. Interest Rate Strategist Ira Jersey.
All right. Coming up on the program, we're going to find out why X is drawing heat from the DSA.
You're listening to Bloomberg Intelligence on Bloomberg Radio, providing in-depth research and data on 2,000 companies and 130 industries. You can access Bloomberg Intelligence via BI Go on the terminal. I'm Paul Sweeney.
And I'm Alix Steele, and this is Bloomberg.
You're listening to the Bloomberg Intelligence Podcast. Catch the program Saturdays at noon Eastern on Bloomberg Radio, the TuneIn app, Bloomberg.com, and the Bloomberg Business app. You can also listen live on Amazon Alexa from our flagship New York station. Just say, Alexa, play Bloomberg 1130.
We'll be here each and every week at this time, tapping into Bloomberg Intelligence analysts covering some 2,000 companies and 130 industries worldwide.
Tech platforms like X could face continuing headline risk under the Digital Services Act, particularly given the current political focus on harmful content. Joining us now is Bloomberg Intelligence technology litigation analyst Tamlin Basin. Tamlin, what is the Digital Services Act?
Yeah, sure, Alex. So the Digital Services Act, or the DSA, is Europe's new content moderation law. It's really a broad, sweeping law that took effect in late August for the largest social media platforms. And what it does is it imposes some pretty tight obligations on them in terms of, one, content moderation, and also transparency over sort of how they are moderating content. If they're going to remove content, they have to give feedback to the user. And this is all backed up with the threat of some pretty stiff financial penalties of up to 6% of a platform's annual revenue.
So who monitors this stuff? Who enforces this DSA?
Right, and this is where it's a little bit different from some other European regulations. For instance, the General Data Protection Regulation, or GDPR, was enforced by individual data protection regulators in countries. But here, the European Commission has said we're going to take direct enforcement powers, at least as it relates to the large platforms. And we think that's where there might be a little bit of heightened risk for these platforms, because the European Commission might be more eager to sort of go after where they see there's some sort of perceived noncompliance.
But it's not like they can just then go to a different social media website, because they're all under this act, right? So if they're all going to get hit with the same thing, how big of a hit is it actually going to be?
Right, and that's absolutely true. Anybody with over sort of 45 million users is going to be subject to the DSA rules. And on the whole, we don't think it's really a huge lift for a lot of companies. These are sort of the same notice and takedown requirements that these platforms have been living with, both in Europe and the U.S., for really the last 10 years. I think the difference is one, that threat of the financial penalty. And then when it comes to sort of what we've seen in the sort of the flare-up of this horrible violence in the Middle East, is that the regulators are really going to try to hold the platforms' feet to the fire. Objectionable content, especially as it relates to sort of terrorist content, that's something that regulators are always going to be looking for in platforms. It's very hard to entirely stamp it out. The key is going to be, are the platforms, once they're made aware of it, are they taking it down as quickly as they need to under the DSA?
What has been the response from some of these social media platforms?
Well, they're all saying that we're complying, and most of them have received letters from the Commission in response to this war in the Middle East, and they're saying, yes, we're doing all we can to take down objectionable content. I think the thing we need to point out is X, I think, is the most in the spotlight just because of all the changes on that platform in recent months and sort of the winnowing out a lot of the staff that I think used to do content moderation. So I think that's the platform that finds itself in a little bit of a different position, and it's really going to have to show compliance, really go through the steps to show that it's complying with this regulation.
You have a really cool pie chart here that shows the breakdown of GDPR fines, and I appreciate that these are different fines, but still, man, Meta, 58%. That's enormous. What's the breakdown kind of going to be in this new one?
Well, I mean, it's going to be all the tech platforms because they're really the only ones that are going to have to comply with this new moderation policy. And I think we're probably going to see X, potentially maybe YouTube, maybe Meta, but it all depends on how they are complying with the law and can they really show the regulators that they're taking their obligations very seriously under this. And I do think if you look at the GDPR, that pie chart, GDPR has been in effect for 5 years. It's really taken a long time for a lot of those damages or a lot of those fines to hit the companies. And I think it might be a little bit of a shorter timeline under the DSA just because the Commission, again, has those direct enforcement powers.
All right. So just to be clear, Tamlin, this Digital Services Act, is this just for the European Union and the UK?
It's for any platform that has 45 million users in the European Union. So really, again, the UK is not really part of the European Union anymore. So it's really looking at the user base in Europe. And so it applies to a certain subset of companies or platforms. And again, sort of X, Meta's Instagram, and Facebook, YouTube, those platforms.
I got to be honest, I feel like I don't think Elon Musk and compliance very often in the same sentence, Paul, and I have to wonder, is he going to take this seriously? Just in the haphazard way it seems like things just get rolled out or done at X.
It doesn't appear to be. I mean, Tamlin, has there been any impact on the stocks at all?
No, not necessarily with the DSA, and I think what they're doing is, again, most of the traded companies, at least, are demonstrating, at least trying very hard to demonstrate to the European Commission that they are taking this very seriously. Musk sort of got in a little bit of a Twitter exchange or X exchange with sort of commissioner who's in charge of enforcing these powers, which kind of speaks to your point, Alix. This is going to make a very interesting test case for how powerful the DSA is, because I think X is going to absolutely be the poster child for enforcement over these next few months.
Oh, what was the exchange? What did he do? What happened?
Thierry Breton, the European Commissioner who's in charge, the portfolio includes DSA, he tweeted X to Musk to say that you need to comply with this new regulation. Musk replied back that, we think we are. If you think we're violating the law, post those tweets, X's below. Obviously, the point is to get this content off the platform as easy as possible or as quickly as possible. So I'm not sure how favorably the regulators looked at that exchange.
Yeah, it's not at all surprising in some ways. All right, Tamlin, thanks so much. Tamlin Basin joining us, Bloomberg Intelligence Technology Litigation Analyst. All right, let's turn now to the digital grocery space, which so far has been an unprofitable channel for most retailers. But as grocers like Walmart and Kroger employ more capital to build their infrastructure, the sector is expected to expand. Let's welcome now Bloomberg Intelligence consumer staples analyst Diana Rosero-Pena. Was this just like the magic of COVID that sort of made this sector kind of break out, and now we're just recovering from that? Where are we in this sector?
Yes, so you're totally right. COVID accelerated a lot of years of penetration that e-commerce was supposed to go through in grocery. So now we're seeing a more normalized yet still elevated demand for the format for retailers.
People still want it?
Yes, absolutely.
Huh. Okay.
All right. So, I mean, supermarket business, what I know, Diana, is razor-thin margins to begin with. Now you layer on the expenses of digital. Is there any path to profitability there, or is that just a business I feel like they got to offer?
Well, definitely there is demand for it. And I think, the genie is out of the bag, or the cat is out of the bag.
Yeah, whatever.
I'm confusing my sayings. But definitely it's a format that consumers still demand it. It's here to stay. It's probably, some forecasts are estimating that it's probably going to be a third of revenue for grocery retailers over the next few years. So definitely is a format here to stay. It's unprofitable for grocery retailers. Obviously, Walmart, the Walmarts, Target, and even Amazons of the world, they are investing and they're building scale, and that is obviously closing that gap. But they're still unprofitable. And
so what would make them profitable? Like people just using them more, or like what would tip the scale for them?
So yes,
or brand loyalty, I guess. Like if I don't know. Absolutely,
definitely is. If people are starting to become, ordering from their online, from websites.
Like if I order from Walmart, I'm going to want to go shop at Walmart or something.
Well,
in theory.
A combination of the two. But there's also another way of revenue or profitability that these companies are exploring, and it's basically the sale of data, data insights that you're getting from building all of this scale and this, getting all this information from your consumers and selling that data to consumer brands that are interested in that.
Talk to us, what's the retail media network?
So, yes, basically is Walmart, for example, trying to monetize the data insights of all the information that they're getting from consumers for their media, and actually, like I said, sell it to brands and being able to position brands, or being able to build campaigns to be more effective.
Campaigns.
Exactly.
So, they're selling advertising because they got 1 million people coming through. And they're saying to Procter & Gamble, buy some advertising on my digital space because I've got a lot of information about what the people are buying and stuff.
And not only that, but I think there's a lot of demand to not only complement, basically do like the omni-channel on that as well. So not only insights on the website, but as well on the store, and being able to complement that campaign across the formats.
How expensive is it, though, to build out this network? Because I can't imagine there are just going to be a handful of players that can afford to kind of take this hit and then keep it going.
Yes, for sure. And we have seen the major retailers, you're talking about Target, Walmart, Kroger, investing a lot on these networks to be able to do this. And obviously the operating margins are exponentially higher. They're between 50 and 70% compared to the mid-single digits of a regular grocery store.
Shoppable videos. What's a shoppable video?
What is this?
Well, for older folks, it's basically
looking at me.
She was not. She was technically not.
I was looking straight. So it's QVC 2.0.
Okay.
Basically, it's you have somebody performing, in this case, will be cooking a meal, and basically on the sides or somewhere on the screen, you'll have links to be able to buy that product that the person is using.
Does it work?
Yeah, well, actually, I will say the end of last year, beginning of this year, Roku and Walmart actually partnered to be able to do a shoppable video or shoppable videos, and the click-throughs were like 3 times of a regular.
Really?
Yeah.
Do they have it for regular clothing shopping?
Well, like I said, QVC 2.0. Probably that will be example. I haven't seen it, but I wouldn't be surprised if that is available.
Do we know? Does Walmart break out? Like, do they make money in their supermarket business, their grocery business?
Yes, they do on the regular retailer. Yes,
they do. Okay.
Yeah.
Is this expected to continue to grow, or was it just kind of a flash in the pan with the pandemic?
Well, so click and collect is supposed to be expected to grow, take some share from delivery, because obviously we're more mobile, so it's easier for you to, select your items and set them aside so you can pick them up, after work or something like that. So it is expected to work to gain share, but delivery is still going to be about 59% of the the
online
grocery
filling.
online filling.
I tell you what I do. I don't go to the full service checkout anymore. I just go to the self-serve. Even if I've got big orders, that's my
That's what I do, and it makes my husband so anxious. He can't handle the inefficiency or something weird. But I also wonder, I have a couple of thoughts. One is that if you get into a downturn in the economy, wouldn't this be the first to go? On the other hand, there's an aging population who can't go and carry carry a gallon of milk, and they're going to need that delivery. And I'm kind of weighing those two things in my head.
So yes, there is some cost to obviously having some items delivered, which is why you will see click and collect being able to gain some share from that. But definitely, like you're saying, for example, I also cover the pet industry. And for you to carry, or for us in the city to carry a 15-pound bag of food, it's a little bit difficult here in the city. So you rather deliver that to your home.
All right, I'll buy it.
All right. Thank you, Diana. Really appreciate it. Diana Rosero-Pena, Bloomberg Intelligence Consumer Staples Analyst. Really interesting.
That's this week's edition of Bloomberg Intelligence on Bloomberg Radio, providing in-depth research and data on 2,000 companies and 130 industries.
And remember, you can access Bloomberg Intelligence through BI Go on the terminal. I'm Alix Steele.
And I'm Paul Sweeney. Stay with us. Today's top stories and global business headlines are coming up right now.